As inflation stays persistent, the question remains, is relief in sight? To give us an update on what we're seeing, we're joined by JPMorgan Private Bank Senior Markets Economist Joe Seydl. Welcome.
Well, thanks for having me.
Joe, many consumers continue to feel the impact of inflation, whether it be at the grocery store or the gas pump. Can you tell us what we're currently seeing and how it compares to this time last year?
Sure. I think first, when we talk about consumer sentiment, there's a difference between what consumers are thinking about with inflation and what economists are typically used to. Consumers, I think, are more concerned with the level of outright prices, which are high. I mean, the level of prices are up by 20% from pre pandemic, but economists are typically interested in the rate of change. That's what the inflation rate is about. And we've seen significant progress over the last year when it comes to inflation. So if you take the Fed's measure of inflation, which is the core PCE inflation index, that was almost 5% a year ago, just under 5%. And today that's at 2.8%. So we've seen some significant progress there. A big question is in about the last 2 months, where it's picked up more to 3.5%. So there's a concern that this might be the start of kind of a new pickup in inflation. So that's the big question now. But generally speaking, over the last year, we've seen pretty significant progress.
And the pandemic's over, so what's driving inflation right now?
Right. So, 12 to 18 months ago, the inflation was much more broad-based. Today, it's more isolated in certain pockets. And so the two main areas that we're seeing inflation is one within housing. Housing inflation is still just under 6%, so it is a pain point. Part of that has to do with the way we measure housing. It's kind of a lagged reflection, but it's also related to increased mobility trends across America. Individuals are moving to lower cost of living cities, and that's kind of putting upward inflationary pressures. The second area that we're seeing it is in the insurance markets. So automobile insurance in America is up 20% year over year, the inflation rate. So very significant pickup in auto insurance. That has to do with the increasing complexity of cars with more electronics in them. And there are some climate impacts related to that as well. So in general, inflation is not as broad-based as it was early on in the pandemic, but we're still seeing these acute areas in housing and auto and the insurance markets that is of concern.
And do we know when consumers can expect to feel some relief?
Well, I think it has already happened. Inflation has come down, but consumers aren't yet convinced because they're looking at the sticker shock of the high level of prices. I think it's just going to take time for incomes to catch up, where consumers see their wage and income growth above the rate of inflation. And that has happened for the last 5 to 6 months. It just hasn't happened for a long enough period where consumers can start to feel good about that. So some function of it is relative to time. And then the other kind of acute issue in America is housing. We do have an affordability housing crisis. We underbuilt homes significantly over the last 10 years, and that's going to take longer to sort itself out. That's going to take years to get back to a more balanced housing market where affordability is achievable again. But we are headed in the right direction with solid income gains and the economy holding up in the context of higher interest rates.
And do you have any advice for investors who are looking to the future and trying to navigate the uncertainties of inflation?
Yeah, I think we learned a lot about the leading indicators of inflation in recent years. So that's been very helpful for investors. You can look at leading indicators of housing inflation, like the vacancy rate in the apartment sector tends to be a good leading indicator of housing inflation. We look at commodity prices as well to lead. I think for investors, if a reacceleration of inflation is kind of the key risk for the outlook, it's very hedgeable, because if that were to happen, it would antagonize the Fed to hike interest rates more, and that would sort of strengthen the dollar. So you can take a long dollar position as a hedge against inflation reaccelerating. It's not our core view. We continue to see inflation falling through this year, but it is a key risk to the outlook that's hedgeable through a position for the strong dollar.
Joe Seydl, a JPMorgan Private Bank Senior Markets Economist, thank you so much for all that great insight and for being here today.
Thanks again.